potential future. So Bitcoin is competing against store of value assets. As of today in 2025, that's about $1 quadrillion. Bonds, real estate, equities, currency, gold, collectibles, fine art, et cetera. It's about $1 quadrillion. By 2030, based off of the U.S. government's projected deficits and debt increase, that should be about $1.6 quadrillion. By 2040, that's $3.5 quadrillion. So what percentage of that basket do we think Bitcoin could get? 2%? 5%? 10%? Let me give you a hint. If it can get to 1.25% by 2030, that puts it at $1 million per Bitcoin. Now, is 1.25% of a market realistic over 20 years, 25 years? Well, Uber and Airbnb both got 10% of their market shares in less than 10. So could we get 1.25? Certainly.
Mark Moss, one of Bitcoin's most outspoken educators, doesn't view Bitcoin as something to be converted back into dollars. For him, it's not an investment he plans to sell, it's his savings. When he wants to buy a house, a car, or pay for travel, he'll use dollars. But when it comes to preserving wealth, his base system is Bitcoin. Moss argues that most people still misunderstand the concept of the asset. They treat it like a stock, asking whether it's too expensive, or comparing the price today to what it was years ago. He points out that no one hesitates to buy Apple or Tesla shares just because they once traded for pennies. Value isn't defined by where it started, it's about where it can go. On the question of price, Moss admits short-term moves are impossible to predict with precision. But he points to multiple indicators suggesting Bitcoin could climb into the $200,000 to $250,000 range this cycle. So when people ask if it's already too late, his response flips the logic. If you could buy something for $100,000 today that might be worth $1 million in a few years, is that expensive, or is it cheap? He then widens the lens. The global store of value markets, gold, real estate, government bonds, together are worth well over $1 quadrillion. If Bitcoin managed to capture just a sliver of that, say a little over 1% by 2030, the math works out to roughly $1 million per coin. That's not a wild assumption when compared to how quickly companies like Uber and Airbnb carved out their share of the market in under a decade. For Moss, Bitcoin isn't speculation. It's simply the soundest place to keep wealth in a world drowning in debt and inflation. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
The Bitcoin system is the new system, and I am selling my dollars to go into the Bitcoin system. At what point will I sell my investments and go back to the dollar? Never. Why? I've left that system. So I don't look at it that way. I look at it as savings.
Yeah.
I buy things. I have multiple houses in multiple countries, and I got cars and, toys and whatnot. But what I save is in Bitcoin. That's my savings. And there's no point where I sell it for dollars ever again. It's not an investment for me. So I would just reframe that. But you can't get there until you've done the work to realize what is actually going on and how big this whole movement is. But what I would say to those people who think it's too expensive, and that was sort of the first question that you asked, is a couple things. Number one, when you think of it as investing, where most people think about it right now, coming in from an NGU perspective, they think about it investing. And so when you're investing, what markets are, the markets are forward-looking. Markets are what we call discounting mechanisms. Markets are a way for me to buy an asset cheaper today than I think it will be valued in the future. People buy Tesla, they buy Apple, they buy Google, they buy Facebook because they believe those companies will be worth more in the future than they are today. More specifically, they think they'll be worth more in the future than holding the dollars will be. And how do we value those? Well, we look at discounted cash flows, forward earnings, right? So Tesla is trading somewhere around like 150 times PE, price to earnings ratio. What that means is that at the current price and earnings of Tesla today, it will take 150 years to be worth what I'm paying today. Palantir is 500. Most of the Mag 7 is like 30 to 50.
Yeah.
Okay. So people buy based off of what they think the future value will be. But everybody talking about Bitcoin is saying what it used to be priced. No one's going, well, I can't buy Amazon or Google or Tesla because it used to be 5 cents. Nobody says that.
Yeah.
It's a crazy way to think about it. So I don't understand why all of a sudden most people are thinking about the future value of companies, but yet with Bitcoin, we always think about the past. Doesn't make any sense to me. But that's what happens. So people are thinking about the past. So what we want to do is think about the future. So the better question to ask is Bitcoin expensive or cheap? Our brains are comparing mechanisms. If I ask you, is this heavy? Heavy compared to what? We need something to relate it to, right? So is Bitcoin expensive or cheap? Compared to what? Well, it's expensive compared to where it was in the past, but is it expensive compared to where it will be in the future? That's how we should be looking at investments, right? So we want to understand, where is it going? And back to Solana, XRP, et cetera, and I kind of asked about bank software. I asked people about XRP. Tell me what the mechanism is. Why do you think XRP goes up in value? What will the potential future be? Where do you come up with those metrics? They can't, right? It's speculative. With Bitcoin, we have all kinds of data. We have 100 different data points that we can measure it against to figure out where it's going. As a matter of fact, I was just working on a YouTube video right now comparing it to the stable coins. So we can look at the total AUM, assets under management, of all stablecoins, and it has a ratio. So as stablecoins have grown from 0 to about 250 billion today, Bitcoin has also gone up on a multiple. So Scott Bessent, head of the U.S. Treasury, just said that he expects stablecoins to be $3.7 trillion by 2030. Okay, well, based off of the historical relationship of stablecoin to Bitcoin, where does that put it? We have all types of metrics we can use. We can think about it from a venture capital perspective. If I'm I am a venture capital investor. If I was going to invest into Uber, what is this Uber? Well, it's going to disrupt taxis. It's going to disrupt limos, vans. Okay, how big are those markets? The TAM, the total addressable market. What is the size? What percentage do I think we can acquire from those? 5%, 10%, and we come up with a valuation. That's what venture capitalists do, because I'm trying to guess a potential future. So Bitcoin is competing against store of value assets. As of today in 2025, that's about $1 quadrillion. Bonds, real estate, equities, currency, gold, collectibles, fine art, et cetera. It's about $1 quadrillion. By 2030, based off of the U.S. government's projected deficits and debt increase, that should be about $1.6 quadrillion. By 2040, that's $3.5 quadrillion. So what percentage of that basket do we think Bitcoin could get? 2%? 5%? 10%? Let me give you a hint. If it can get to 1.25% by 2030, that puts it at $1 million per Bitcoin. Now, is 1.25% of a market realistic over 20 years, 25 years? Well, Uber and Airbnb both got 10% of their market shares in less than 10. So could we get 1.25? Certainly. Yeah. There's a whole bunch of ways we can look at it through on-chain data. So for example, the pi top cycle indicator is like the most accurate indicator that we've had. It's nailed every single top for the last several cycles. And it's projecting. These are moving indicators, so people trying to guess this on the short term, you won't ever know because these things are moving based off of volume and whatnot. But many indicators are showing Bitcoin could hit 250 just this cycle alone. So then the question I would ask is Bitcoin too expensive? Too expensive compared to what? If I could buy $1 million asset for $100,000 today, is that cheap or is that expensive?
Mark Moss notes that history is replete with experiments involving money. People tried barter, shells, rocks, coins. But gold became the winner because it had the right mix of qualities. It was portable, divisible, durable, recognizable, and scarce enough to hold value. Still, it wasn't perfectly scarce. Every year, about 1.5% of new gold is mined, and in the past, significant discoveries have caused shocks. Spain's flood of silver from the Americas in the 1500s is a famous case. The sudden surge in supply sent prices soaring even though real economic output hadn't changed. The lesson is simple. When the money supply grows faster than wealth creation, inflation follows, even under a gold or silver standard. Gold worked better than most, but it still had cracks in the system. This is where Bitcoin breaks the pattern. Its supply is permanently capped at 21 million. Once all coins are mined, that's it. No central bank, no miner, no discovery can inflate the total. Even if demand pushes Bitcoin's price through the roof, no extra coins appear. The protocol adjusts, keeping issuance on schedule. That single feature makes Bitcoin different from every form of money that came before. Gold's rising price always lured more miners to dig up new supply, diluting its scarcity. Bitcoin removes that feedback loop entirely. Scarcity is locked in by design, not by geology or human discipline. Moss argues that this solves the oldest problem in monetary history, the constant temptation to inflate the money supply. Let's get back to the interview.
We first have to understand that we don't want money. Which sounds crazy because most of us spend most of our life trying to get money, but we don't want money. What we want is the goods and services that money buys us. That's wealth. Yeah. Buildings and houses and cars and clothes and food. That's wealth, not money. The money is a medium of exchange. It's a way for us to get the things that we want, to get the wealth. So that's the first thing, if you understand that. So then what we have is all the wealth of the world, which is always expanding. We're always creating new things, inventing new things, right? The wealth continues to grow and expand. You have all the wealth of the world divided by all the money of the world. So that's number one. Money can't just be printed for free. It can't just be created out of thin air. There must be some form of scarcity around that. If I have to work to earn money, but someone else can print it for free, it's going to lead to slavery every time. So money has to be scarce. And so the problem with fiat money or debt-based monetary system is that they just print it unlimited. And what happens is my $1 equals a percentage or share of the wealth of the world. Like if I bought 1% of Microsoft or Tesla, but every time or let's use Strategy as an example. Yeah. But every time Michael Saylor hits the ATM and sells more shares, I get diluted. So now my $1 doesn't equal the same amount of wealth in the world. I have less, which is why it takes more of those dollars to buy more things. So if we go to a monetary system that's more scarce, I can maintain my share of the wealth of the world better. So over millennia, over thousands and thousands of years, there's been different things used for money, whether it was a barter system where I trade you a bushel of wheat for a cow. I trade you my labor for some chickens. We had obviously coinage, right? We've had feathers, rocks, seashells. Coinage happened, and gold emerged as the best form of money because it has the best money attributes. Money attributes are portable, divisible, durable, recognizable, saleable. And so gold had the best attributes for that, and scarce. Now, gold isn't totally scarce. We still dig it up out of the ground every single day. It has about a 1.5% inflation rate, meaning stock to flow. The existing stock of gold in the world, the new rate of gold coming out of the ground, the flow, it's about 1.5% inflation per year. Now, that worked really well because now we had something, a commodity that met the attributes of money. It was fungible. Anyone anywhere in the world could dig up gold. No matter where you got the gold in the world, it was fungible. Gold's gold. But in that period, it wasn't always perfect because anytime you rapidly increase the monetary supply without a corresponding increase in wealth, you have inflation. Yeah. So even on a hard money system, we had the problems. Oh, we discovered this new gold well, right? As a matter of fact, in the 1500s, in Spain, they sent off the ships over to Central America and discovered vast resources of silver. And they brought all the silver back and they created massive inflation because they rapidly increased the monetary supply without expanding the production, the efficiency, right? So even on a gold or a hard money system, you still have the same problem. You can't rapidly increase the monetary supply without increasing the production at the same time. Okay, but that's the best system that we have until now. Because now Bitcoin gives us a fixed monetary supply, so there will never be more than 21 million. Unlike gold that still has a 1.5% inflation, Bitcoin will have a 0% inflation. But also, as of right now, we're still mining Bitcoin, right? We're still bringing Bitcoin into existence, if you will. Yeah. With gold, again, we could just discover a bunch in South America like we did in the past. Or let's say today that the price of gold went to $10,000 an ounce. If the price of gold went to $10,000 an ounce, more people would go mine for gold. And if more people mine for gold, more gold would come out of the ground. We'd increase the inflation rate again. But with Bitcoin, even if Bitcoin went to $5 million today, more people would go mine Bitcoin, but it wouldn't bring any more back out of the ground. So it fixes that inflation problem that we've had in the past.
Bitcoin is catching its breath after hitting a fresh all-time high. Just 4 days ago, it broke past $124,300. Today, it's trading closer to $115,300, down 2% on the day and 6% for the week. The 7-day range has tightened between $115,355 and $123,780, showing consolidation after a sharp rally. The pullback hasn't been quiet. Liquidations have surged across exchanges, with over 131,000 traders wiped out in the past 24 hours alone. That added up to $550 million in forced exits, including one massive $7.8 million Bitcoin position on BitMEX. Even with the shakeout, more than $6 billion in short interest remains open. If the price makes another run toward $124,000, that stack of shorts could unwind quickly, setting up a potential squeeze. On-chain data adds an interesting twist. Axel Adler Jr., an analyst at CryptoQuant, notes that short-term holders currently account for 47% of Bitcoin's realized cap. In plain terms, nearly half of the value locked into Bitcoin right now belongs to newer buyers. Yet in the last 30 days, there's been almost no shift between short-term and long-term hands. The net change has been zero, which suggests recent volatility hasn't meaningfully shaken coins loose from newer wallets. That balance matters. If short-term holders hold their ground while shorts remain heavy, Bitcoin could be primed for another sharp move. Whether the next test comes on the upside or downside, the pressure is building. So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.